What's up everybody? In today's video we're going to be going over my watch list. These are all companies that I have thoroughly investigated and determined to be great companies that I'd eventually like to own. The only problem is that they are too pricey for my liking at the moment. So what I do is I place them on a watch list and patiently wait for a better opportunity to buy them at a more reasonable price. Because there are 8 of them and the full video is going to be longer than most of you would like, I broke them up into shorter videos on each stock. You'll be able to find all the individual videos by following the link to the playlist right up here. You can also click on the thumbnails at the end of each video and it will take you to the next stock on my watch list. So without further ado, let's get started. The first company on my watch list is ULTA Beauty, ticker ULTA. ULTA is the largest specialty beauty retailer in the US with nearly 40% market share. This stock has been my watch list for quite a while, long before we got word that Buffett bought it. Most of the revenues come from cosmetics, followed by hair care, skin care, and other products and services. The beauty industry is extremely competitive and it's very difficult to establish a strong competitive advantage, but with the growth and profitability that ULTA has delivered over the past decade, it's obvious they have established some sort of advantage, just not what Buffett would consider a wide moat. I don't believe that Berkshire's purchase of ULTA came from Warren Buffett himself. Sure, they have a strong brand due to a wide variety of the best products and the experience that they offer when you buy from them. They also have a very strong rewards program with 40 million plus members, which allows them to effortlessly collect data on their existing customers' buying habits and to advertise directly to them and generate repeat purchases. But they're in a cutthroat industry, and recently they've been offering discounts and promotions to drive sales, which is not uncommon in this industry. This is not the kind of industry or company that Buffett himself invests in. There's just too much competition. Having said that, ULTA's financials speak for themselves. Revenues have been increasing in the 10 to 15% range, although that growth has slowed considerably over the past 1 to 2 years. So much so that the company recently posted a 1.2% same-store sales decline and guided to a potential full-year drop in same-store sales, which is rare for ULTA. Free cash flow is strong with about a 9% free cash flow margin, but cash flows did tick down in 2024 due to a deceleration of revenue growth, rising expenses, and an increase in working capital requirements. Earnings have historically been strong, growing around 20% per year, but recent headwinds have considerably slowed the earnings growth, which is why the stock has been hammered over the past year, and we find ourselves with this opportunity to buy a strong company at a pretty attractive price. Their shareholder returns are okay, not spectacular. They buy back 2 to 3% of shares outstanding, but they don't pay a dividend. Profitability is decent on an absolute level, but great compared to the industry. And this is one of the best things you can see when investigating a company. Rising margins over the long term. And their return on invested capital right here has been expanding consistently over the past 20 years as well. It's gone from around 5% all the way up to 35 to 40% range. That's about as big an expansion as I've ever seen from a company. You don't get their earnings and cash flow growth or this expansion of profitability over the long term without a meaningful competitive advantage. The only caveat is that their advantage just isn't as strong as something like Apple or Visa because their industry is so crowded. This is the only stock on my watch list where the valuation is reasonable, with a forward PE of 16, 1.6 times sales, and an awesome 4.9% free cash flow yield. It's obvious that ULTA is trading at a discount right now, partially because of the recent weakness, but also because they're maturing as a company and will most likely not post the 15% sales growth that they have in the past. Morningstar values them at $390, while CFRA says $463. The only reason why I don't own the stock right now is the lack of a wide moat in a cutthroat industry. If I'm going to hold a stock like that, I need a larger margin of safety than I usually require. I estimate their fair value to be around $457, but with a 30% margin of safety, I'd only be willing to pay $320. The second company on my watch list is Fastenal, ticker FAST. Fastenal competes in the industrial space where they specialize in the manufacturing and sale of fasteners, procurement and inventory management services, and industrial and construction supplies. They sell their products worldwide and across dozens of different sub-industries like electrical, plumbing, farmers, truckers, railroads, mining companies, and the list goes on and on. They hold a wide moat due to a cost advantage as well as switching costs. Switching costs come from their 100,000 installed base of vending machines on site at their customers' facilities, where their customers order whatever parts they need on demand. A natural extension of having these vending machines in their customers' facilities is to offer optimized procurement and inventory management services. This creates enormous convenience and a very tight relationship with their customers. customers. It is costly for their customers to switch to a competitor. Revenues are increasing at a very nice rate of 8% given their size and maturity. They do compete in cyclical markets, however, and so go their revenues, but if you look across a full business cycle, they're able to achieve consistent growth in their revenues, earnings, and cash flows. Not only that, but their profitability is outstanding given the industry they compete in. Their baseline return on invested capital is an outstanding 30 to 35%, while their margins come in at 20% and 14% for operating and net margins, respectively. Even though their cost of capital is 10%, they still earn 20 to 25% on their investments. This is a clear indication that they hold a significant competitive advantage, as I outlined earlier. They currently pay a 2.2% dividend yield, which has been growing at a robust 12% per year, but that's the extent of their shareholder returns. They don't buy back much stock. In terms of valuation, they're a bit expensive. They trade at a 32 PE, 5 times sales, and a 3% cash flow yield, which is below the minimum 3.5% yield that I like to see. Fastenal has always traded at high prices, perhaps because of their wide moat and consistent growth. Morningstar values them at $51, while CFRA has their intrinsic value estimate at $40, and I value them at $33. Next on the list is the world-famous video streaming platform Netflix, ticker NFLX. As the world has moved away from traditional TV networks towards video streaming, Netflix has capitalized by building the world's undisputed market-leading platform in video streaming, supported by their first-mover advantage. One of the advantages of being the first mover is the fact that they have already gone through the initial multi-year cash burn phase associated with building out a streaming service, while most of their competitors are going through that as we speak. They turned cash flow positive in 2020 and it spiked in 2023, but don't let this fool you. It was the result of a significant decrease in content spending due to the actors and writers strike in 2023. If we assume the same content spending growth as they saw over the 2020 to 2022 period, their cash flow would be in the $3 billion range, not $6 billion. Having said that, $3 billion is quite a jump from the 2020 to 2022 run rate, suggesting that they are on the cusp of a free cash flow breakout. The other benefit of being the first mover is the fact that they accumulated their massive subscriber base long before every media company and their mothers entered the streaming market. This subscriber base, the largest for any media company in the world, allowed them to generate the cash necessary to produce the wildly popular content that it did, which attracted more customers, which generated more cash and led to their ability to secure and create more great content, which attracted even more customers, and so on. It's a self-reinforcing cycle known as the network effect. Revenues have historically increased at a very rapid rate, around 15 to 20%, but it has been slowing and is expected to continue to slow into the high single to low double digits as the company matures and faces increased competition. They have already achieved significant saturation in their top markets of the US, Canada, and Europe. As you can see here, they're now relying on the Middle East, Africa, Latin America, and Asia to drive their subscriber growth. This is all good, but Netflix isn't able to charge as much in those regions, meaning that as they build a larger and larger subscriber base in those markets, there will be downward pressure on their overall margins. To offset this margin pressure, they have started to incorporate advertising into their programming. Advertising is their next great revenue source and comes with higher margins than the streaming segments, which should more than offset the downward pressure on margins. Earnings have grown nicely, although they have stagnated over the past few years as competition has increased in the streaming industry. They carry more debt than cash, although it is quite manageable at current levels if you consider their 10 times interest coverage ratio. However, based on their debt-to-equity ratio, and I'm including their capital leases in the calculation, they're heavily indebted with about a 94% debt-to-equity ratio, significantly higher than what I'd like to see, and it's one of the reasons that Netflix is lower on my watch list. Their shareholder distributions are horrible. They don't pay a dividend, and in the past, it has only bought back enough stock to offset the dilution from stock-based compensation. And I get why they haven't returned much to shareholders. They were a rapidly growing, profitable company that had good reason to focus mainly on subscriber growth. As they mature, provided they keep the stranglehold on the video streaming market, we should see them start to return more of their profits to shareholders. Maybe not through a dividend, but surely through generous share buybacks. In fact, they still have $8 billion in share buybacks authorized and are surely going to authorize even more in the near future. In the second half of 2023, they really started pouring excess cash into share buybacks. As long as they keep up this level of repurchases, we should see them buy back around 2% of shares outstanding going forward, which will help put a floor under their earnings per share growth. Their profitability is decent but not great, with baseline return on invested capital and margins of about 15%, and it's good to see their margins are expanding consistently. In fact, Morningstar thinks that they can continue to expand their margins to 30% within the next 4 years, as the company transitions from a high-growth, mid-cap company into a more mature, profitable, and cash flow generating company. It would be quite an accomplishment if they were able to achieve these 30% margins that quickly. I'm not nearly that bullish on this company. The valuation is stretched with a 31 forward PE, 8 times sales, and a paltry 2% free cash flow yield. Morningstar values them at $500 per share, while CFRA values them at $704 per share, and I put a $352 intrinsic value on the company, but with a 20% margin of safety, I'd only be willing to pay $281. Next, we have FTNT, ticker FTNT. FTNT is a global leader in security-driven networking products and cybersecurity solutions such as next-generation firewalls, software-defined wide-area networking, and threat vulnerability management, to name a few. About 2/3 of their sales are subscription services, which tend to be more sticky than their product sales. They compete with the likes of Cisco, CrowdStrike, Zscaler, and Palo Alto Networks, and they've built a wide moat based on switching costs and a network effect, both of which reinforce the other. FTNT offers a comprehensive networking and cybersecurity solution that, once installed, touches many points throughout a company. It requires significant amounts of training and would be costly and temporarily increase a company's vulnerability to cyber attacks if they were to move away from FTNT. And during the time that a company uses FTNT products, their platform is collecting massive amounts of data about the company's network and the threats that it faces. This data is used to uncover new threats that is then used to update its entire customer base's security situation. As the data pours in and the platform is continuously updated, it becomes better at detecting and guarding against threats, which in turn attracts more customers due to superior product, which results in even more data being collected and integrated into the solutions, thereby increasing the cost of moving to a competitor. You get this self-reinforcing loop of data leading to a network effect, which increases the cost of using a competitor and attracts new competitors, which further increases the switching costs, which leads to an even stronger network effect, and so on. Their financials look fantastic, with revenues and free cash flow growing like gangbusters in the 20 to 25% range, earnings growing over 30% per year over the past 5 years, and they're highly profitable with a baseline return on invested capital around 20% and a net margin of 17 to 18%. And best of all, their profitability has been expanding over the past 5 years. You'll notice this V pattern in their earnings and profitability metrics. Early on in their existence, they relied more heavily on the sale of physical products with a perpetual license rather than subscription-based offerings. The growth in their operating expenses was exceeding the revenue growth, leading to declining profitability. In the 2011-2012 period, they switched to a subscription model. This drop in earnings and profitability was the period in which they were working through the transition to a subscription-based model. This drop in profitability is common when making this switch. You can see a similar pattern in Adobe's and Microsoft's financials as they move to a subscription-based service as well. The main warts on FTNT is that they are on the expensive side, and their shareholder returns are subpar at best. They sport a 33 forward PE, 11 times sales, and a measly 2.3% free cash flow yield. They don't pay a dividend, but they have begun to buy back around 2% of shares outstanding over the past 5 years. This is still a very young company. It was incorporated in 2000 and is still growing very rapidly, especially after its move to a subscription-based model. Given their insane growth rate, management has decided that the best use of their money is to plow it back into the business to grow even further. So far, it's working, and investors are willing to pay a premium to hold their shares. Morningstar values them at $77 per share, while CFRA puts a $65 fair value estimate on them, and I value them at $76 per share, but with the 20% margin of safety, I'm only willing to pay $61. Next up is one of my favorites, and it's Arista Networks, ticker ANET. Arista competes with Cisco, Hewlett-Packard, Dell, and several others in the network management space, where Arista's high-performance Ethernet switches, paired with its open and programmable software, is taking advantage of the gaps in traditional networking. Arista currently has the most market share in the high-speed switching market and is looking to expand and take market share from Cisco in the lower-end markets as well. Arista's value proposition appeals to a large portion of the network management market, but it specifically appeals to large-scale cloud companies like the Magnificent Seven, cloud service providers, and next-generation data centers and campuses involved in AI and other next-generation technology because it increases network speeds and it drives down the cost of managing a network. In fact, Microsoft and Meta make up 39% of Arista's sales, which can be seen as a positive because of the size, strength, and CapEx budgets of those two tech titans, but it also presents a risk as we saw in 2019 and 2020 when Meta decided they were going to skip an upgrade cycle. Arista's revenue dropped 20% right here from peak to trough. When only a couple companies have that big of an impact on a business, you better be aware of it. They hold a wide moat due primarily to switching costs, but their market position in the high-speed market combined with product differentiation also contributes to their competitive advantage. Switching costs are the costs that an existing Arista customer would incur if they decided to switch to one of Arista's competitors for its network solutions. Arista's proprietary software and hardware configurations require training and certifications, which can require weeks of class, hours of testing, and tens and thousands of dollars in expense. Furthermore, networking setups take months to implement and years to optimize. If a company were to switch away from Arista, it would require wholesale retraining of its workforce under a new vendor, inclusive of the time and expense to do so. Arista is growing like gangbusters, with revenue up 30% plus per year over the past 3, 5, and 10 years, while earnings are growing 50% per year. Cash flows are also growing rapidly, but it can be a bit deceiving as a result of the huge increase in free cash flow in 2023. Prior to 2023, their cash flows were stagnant, due primarily to the large research and development and CapEx spending required to grow market share in their end markets. It will be interesting to see what level of free cash flow they print in 2024. If Q1 and Q2 are any indication, 2024 is off to a good start. Profitability is a mixed bag with a baseline return on capital at only 15 to 20%. It's still a level where internal investments are creating value, but not at the level that I would expect. Cisco's return on capital also falls in this 15 to 20% range. It appears that the large investments into R&D, CapEx, and manufacturing required to compete in these networking markets naturally limit the return on investment. But if we turn to the operating and net profit margins, we see a beautiful thing. High and increasing margins, supporting the notion that Arista enjoys a competitive advantage in the industry. The main disappointment I have with Arista is the lack of shareholder returns. They don't pay a dividend, and they don't buy back enough shares to offset the dilutive effect of stock-based compensation. This is a pure long-term growth bet. Arista is focusing on expanding market share and growing revenues, so they're plowing most of the cash and earnings they generate back into the company to achieve those two objectives. The only payoff an investor gets with Arista is price appreciation, which has been great, with a 536% return over the past 5 years and a 1,724% return over the past 10. This rapid appreciation is one of the reasons I don't currently hold Arista, and you find it on my watch list. It's just a bit too expensive for me at the moment. It carries a 41 forward PE, 19 times price to sales, and a 2% free cash flow yield. Morningstar values it at $270, while CFRA values it at $323, and I put a $276 valuation on it, but with a 20% margin of safety, I'd only be willing to pay $221 per share. I'm on the sidelines waiting for a nice dip. If you're interested in a deep dive on Arista, I did a video a month or so ago. You can check it out here. Next on my watch list is AutoZone, ticker AZO. AutoZone, along with O'Reilly, dominate the retail auto parts market. Not only do they operate those retail stores that service the general public, 30% of their sales are to other businesses. The good news is that both the retail and business-to-business segments are sticky, given that the average age of U.S. vehicles has been consistently climbing over the past 15 years. In fact, the average age of U.S. vehicles hit a record 12.5 years in 2023 and is expected to remain over 10 years for the foreseeable future. In other words, the demand for aftermarket parts and accessories is expected to continue to be strong. Additionally, demand for auto parts tends to be more protected from macroeconomic conditions than other industries, which contributes to the stability of their revenues, earnings, and cash flow that we'll take a look at later. They carry a wide moat based on a cost advantage as well as brand strength. Their brand strength comes from their superior customer service and massive catalog of parts. And this massive catalog of parts is made possible by their hub and spoke distribution model and automated inventory control system, which reduces the cost of distributing their inventory and also feeds back into the elite customer service. That's the first part of their cost advantage. The second is their extremely good relationships with their suppliers. So good that they've negotiated account payable terms that every retail outlet dreams of. They are given so long to pay their bill for their inventory that they are able to nearly sell that inventory before the bill is due. This is called a negative cash conversion cycle and allows AutoZone to generate the huge returns on capital that they do. Revenues, net income, and cash flow are growing consistently in the 7 to 10% range, with the exception of declining cash flows over the past 4 years, which is being driven by higher capital expenditures and maintaining inventory levels. It's a bit concerning, but nothing to be alarmed about yet. It will be if cash flow continues this trend. On the other hand, earnings per share has grown at a much more robust 15 to 20%. And this is because they direct all their earnings and then some to buying back shares. In fact, this is one of the risks with this company. They're consistently taking on debt to buy back enormous amounts of shares, so much so that their equity is negative. That's right, their equity is negative. This earnings per share growth is a huge contributor to their 500% return over the past 10 years. So I'm just a little bit hesitant when I see their cash flow declining and the increasing debt loads to buy back shares in order to pump up the earnings per share. Feels like they're running this company like a casino. Profitability is outstanding. With a baseline return on invested capital of 40%, they're generating immense amounts of value above and beyond their cost of capital, and margins are strong and increasing. And what's so tempting is that they look like they're trading at a very fair price given the quality of the company. Their 19 forward PE is right around the S&P 500's long-term average PE. They trade at 3 times sales, and they offer a 3.4% free cash flow yield. But Morningstar and CFRA seem to think that they're a bit overvalued. Morningstar estimates their fair value at $2,550, while CFRA values them at $2,700, and I have them at $2,917, but with a 30% margin of safety, I'd only be willing to pay $2,042. Next, we have NVIDIA. NVIDIA is the almighty chip company that literally invented the graphics processing unit, or GPU, and they've dominated that market ever since, capitalizing massively on the push towards digitization, automation, and AI. Their wide moat comes primarily from their first mover advantage, but they also hold intellectual property rights for their GPU designs, and there are switching costs from their proprietary AI training platform. We're all aware of how awesome NVIDIA has become in terms of growth rate and stock price appreciation, and I'm fully on board. I doubled my money in it back in 2022, but sold too early. It's a good company, seeing the demand for its products explode, and it's taken advantage. Revenues, cash flows, earnings, all growing 30, 40, 50% per year over the past 10, and profitability is increasing. Expectations are that this growth will continue for at least the next few years and possibly the next decade. But it doesn't take a genius to realize that companies can't grow at this rate forever, especially when the company is already this big. Having said that, there are 3 additional risks that I see that could be the catalyst for a sizable pullback in this stock, allowing us to establish a position at a much better price than where it trades today. First, there is a certain probability that AI-related investment throughout the world is getting way ahead of itself, just like with the internet. If all this investment can't show a significant return on investment over the next year or so, we could see a huge bust, just like we did for stocks like Cisco, Intel, Amazon, Priceline, and more during the dot-com crash. It's not that the AI and related build-out will go away. Rather, it could slow down or even pause for a little while, which would mean that all of the revenue growth baked into the price of NVIDIA stock would be eliminated and the price would drop precipitously. There is also the prospect of increased competition in the industry. AMD and Intel are working on their own GPUs to compete with NVIDIA. Apple, Google, and Amazon already have their own AI-capable chips, and both Microsoft and Meta have announced plans to start working on their own chips. The sheer cost of these chips and the huge backlog that has persisted over the past couple of years provides the incentives for these tech titans to contract with other GPU producers for business continuity purposes or to develop their own chips, because it's much cheaper to manufacture them in-house than it is to buy from NVIDIA. Lastly, the cyclical nature of the markets they serve, which include data centers, gaming, smartphones, PCs, and cryptocurrency mining also pose a risk to NVIDIA's growth and therefore stock price. In fact, we just went through a cyclical downturn in the semiconductor industry in late 2022, early 2023, where industry-wide sales dropped about 12% and NVIDIA's stock price dropped 36% from around $19 to $12 over the back half of 2022. There have also been 5 pullbacks of at least 15% in NVIDIA's stock price over the past 4 years. We had the massive 63% drop when the Fed started raising interest rates and chip sales showed their true cyclical nature and fell 12%. Then we had a 16% pullback in 2023 and pullbacks of 20%, 27%, and another 20% in 2024 alone. This is a highly volatile stock, and we will get a better opportunity to buy the stock at a better price at some point in the near future. But at what price should we be targeting? Morningstar estimates their fair value at $105, while CFRA puts it at $122, and I value them at $127, but with a 30% margin of safety, I'd only be willing to pay $89. The final stock on my watch list is the one and only Costco, ticker COST. I have a much different view of Costco than most. The majority of people view Costco as an elite company. In my opinion, it's mainly because Warren Buffett and Charlie Munger love the company and the fact that the stock just performs. It just does. And over long periods of time too. It's nothing like a fad or a momentum play like most of the chip stocks these days. But Costco isn't elite. It's a strong company, but it's not elite. It's not in the same conversation as Microsoft or Visa. Costco's industry and business model just don't allow for the same level of profitability or cash generation. I know many of you will strongly disagree, so to end this video, I will give you the pro and what I call the not so fast argument for the company. Let's start off with what's not so great. First and foremost, they're barely profitable because of the massive fixed cost that they bear with their huge warehouses, mountains of inventory, and 250,000 employees. They get to keep less than $3 for every $100 in sales. And half of that $3 that they get to keep is because they charge a membership fee, which comes with huge margins. The problem is that their membership fee only makes up 2 to 3% of their revenue, so it doesn't have a large effect on their profitability. Morningstar estimates that the non-membership portion of their business generates a 1 to 1.5% margin, while the membership fees account for the other 1 to 1.5%. Their cash flow margins are no better. They just posted an all-time high of $6 billion in free cash flow in 2023 on all-time high revenues of $240 billion. That's less than a 3% cash flow margin. I can feel the Costco supporters yelling at their screens right now. But they have a wide moat and a 90% plus membership renewal rate. They're meticulous at keeping expenses low through warehousing the merchandise in their stores and displaying them on planks rather than nice, neat shelves. They have significant bargaining ability with their suppliers due to the volume of product that they move. And Morningstar estimates that they hold a 61% market share in the U.S. discount warehouse industry. And my response is, that's great. Those factors make them a good company indeed, but not an elite one. You see, all those factors that I just mentioned resolve themselves in 2 metrics for any company: the profit margin and the cash flows that the company generates, both of which are horrible with Costco. And they make up for it with higher volumes, which they have been successful at. But it doesn't change the fact that they have to work extremely hard just to keep $3 out of every $100. Their industry and business model constrain the company's ability to generate enormous amounts of earnings and cash like you can get in other industries. Then there are the special dividends. Dividend investors love Costco because every 2 to 3 years they pay a special dividend. But you can't just look at one aspect of it. You need to look at total shareholder returns, which includes both dividends as well as share buybacks. They offer only about a 0.5% dividend yield, all because the stock is so dang expensive. Even worse, they don't buy back any shares. What's going on here is that Costco holds on to excess cash as it piles up instead of paying it out in the form of a higher dividend or through quarterly share buybacks like most companies do. They sit on your cash and they give it to you a couple years later as if they're doing you a solid. They're not. They're actually costing investors returns. First in the form of time value of money. Had they been paying out a higher dividend instead of accumulating the cash, you could have bought shares earlier, giving them longer to compound and generate even more dividends themselves. Or if they bought back shares on a quarterly basis with that money, then they'd be able to report even higher earnings per share than they did, which should result in higher stock price on the shares that you own. In this case, there are nothing special about these special dividends. They know they can increase the dividend or buy back shares. If it's just a one-time payment, then that's one thing. It's another thing to do it 5 times in a little over 10 years. It's obvious that the company easily supports higher shareholder returns. They just choose not to, and it's costing investors. The last knock on this stock is their valuation. Their valuation is absurd, in my opinion, and it's the reason why you find Costco on my watch list instead of as a holding in my portfolio. A 51 forward PE and a 1.5% free cash flow yield is simply unjustified for a company that supports a 3% margin and is growing revenues at around 3 to 5% over the past couple years. Not even high growth tech companies like Arista Networks, NVIDIA, or Microsoft, who are growing revenues in the 10 to 15% range and sport 30% plus margins, are trading at such absurd levels. This company is severely overpriced in my opinion, and both Morningstar and CFRA agree. Morningstar puts a $510 fair value estimate on the company, while CFRA estimates their intrinsic value at $700. And I put a $400 price tag on it, but with a 10% margin of safety, I'd only be willing to pay $360. So those are the sore spots. Let's take a look at the qualities that make this a great company, not just one that keeps 3 out of every $100 in revenues. Revenues are growing around 10% per year over the past 5 to 10 years, which is fantastic for such a large company. But that rate has slowed over the past couple of years. You can see the 2 pops right here where consumers were dealing with a spike in inflation in 2021 and 2022. Those were a bit of an anomaly, with revenues increasing 18 and 15% respectively in those years. Their baseline growth rate is more in the 7 to 8% range, which is still really good for a company of this size. Amazon is on another level, but compare Costco's revenue growth to BJ's Wholesale, Target, and Walmart, all of which are growing slower than Costco. You see a similar story with their earnings, but cash flow is going gangbusters, growing at around 20% per year, which is supporting the 13% growth rate in their dividend. They do carry quite a bit of debt, but they're in a net cash position, so it doesn't bother me too much. I would like to see them pay that down a little though. Additionally, we're seeing some margin expansion over the past 15 years as they optimize their distribution and inventory management model, implement operational efficiencies with digitization and automation, and raise the price of their membership every 3 to 5 years. According to Morningstar, they see Costco's margins approaching 4% over the next 10 years. And even though their margins are low, they are able to maintain and grow their margins that high because of great management and a cost advantage in their industry. They house their mountains of inventory in the warehouses where customers shop, which limits transportation and storage costs. They display their products in a crude fashion so they don't have to carry more headcount to maintain pretty little displays like many of their competitors. They limit the types of products that they sell to about 1/20th of what Target and Walmart do, which reduces inventory procurement and carrying costs. And the huge volume of product that they move allows them to negotiate better terms with their suppliers than their competitors can. All of these support their cost advantage, which allows Costco to offer incredible deals and focus their efforts on volume, which they execute to perfection. Costco generates an outstanding $1,900 of sales per square foot. Compared that to Walmart at $600, Target at $450, and Kroger at $830 per square foot, and they're nowhere close to Costco. Their return on invested capital is quite robust for this industry at around 20%. You may look at that and think it's pretty low compared to the tech giants or Visa or Fastenal, and that is true. All these companies generate much higher return on invested capital than Costco does. But return on invested capital is industry specific because of the different fixed cost requirements that come with their capital light business models. But if we compare the return on invested capital to firms in their industry like Walmart, Amazon, Target, BJ's Wholesale, and Kroger, you'll see that Costco's 20% return on capital is actually quite high. And better yet, it's increasing, unlike Walmart, which has seen their return on capital and margins decrease over the past 20 years. Well, that'll do it. I'd love to hear your thoughts on Costco in the comments. Are you a buyer or a seller? If there are any other companies that you'd like me to take a look at, feel free to leave them in the comments as well, and I'll eventually get around to them. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way to help me grow this channel if you find this content valuable. Lastly, to continue to the next great company on my watch list, click one of the thumbnails that you see on your screen right now. Until next time, you all take care. I'll see you in the next one.